My name's Paul Fynes. I'm an independent financial advisor through City Capital Financial Planning, and I'm here today to talk about benefits that limited company directors can set up, whether that's through the business or indeed personally. The first area I want to discuss is pension planning, and this is very important to a lot of limited company directors because quite often they do not have a pension set up for themselves to provide effectively a pot of assets aside now for later in life. It's a very efficient mechanism to pay into a pension from your business. You can pay up to £40,000 per annum, and all of which will be a business expense, offsetting against corporation tax, and there's no personal taxation to pay. While the money is invested, you will receive growth that's free of capital gains tax and indeed income tax, and you're able to withdraw from the pension from the age of 55 onwards, at which point in time you can withdraw 25% tax-free, with the remaining amount drawn under your tax thresholds. The second area that I want to discuss is protection planning. And just like the pension, it's very often that limited company directors don't have protection benefits for themselves or indeed their family, which arguably is most paramount, given that if you are working for a big corporation, you would receive these following benefits as pretty much standard part of the benefits package. The first one's life cover. You can put life cover through the business as a tax-deductible expense. The company pays the premium, and it's really designed to cover debts like your mortgage, or simply to provide protection for your loved ones in order to continue their standard of living if indeed you're not here to provide that income for them. The second area is income protection. Again, this can also be paid through the business as a tax-deductible expense. If you were employed by a big corporation, you'd often have long-term sick pay in place, so you should normally replace that benefit by your own company, effectively replacing the loss of income if you were incapacitated. It's tax efficient, and it also gives you that health maintenance, that security, that if you are incapacitated, your fixed costs will still be paid on a monthly basis. Third is private medical insurance. This can be put through the company, but there's very marginal tax benefits if indeed it's for a single director. And this is because the premium will be part of your P11D benefits and tax in kind benefits. Where PMI becomes more advantageous through the business is if you have 3 directors or more, at which point in time the medical insurer will often provide discounted rates based on a group scheme. A lot of clients, a lot of limited company clients often have large cash balances within their business, reason being that they generally draw down from the business up to their threshold income, and they do not want to pay more than the basic rate of dividend tax or income tax. So over periods of time, that cash balance generally increases. And in this current climate with low interest rates and relatively increasing inflation rates, it's often found that clients are keen to make their money work harder for them. So a very useful way is to invest via what's known as a company investment account. And this quite simply just gives you the opportunity for growth over and above cash. And indeed, if you do not want to withdraw all the capital and pay the income tax or dividend tax on it. In terms of sort of personal areas outside of the business, we'd certainly look at suggesting setting up critical illness cover, which is designed to pay a tax-free lump sum in the event of a critical illness, often 12 to 14 days after diagnosis. And this is designed for an individual to pay off any debt or indeed to cover loss of income from a flexible nature, i.e. they can withdraw and at least take income from the lump sum that's been paid. In addition to this, we'd look at utilising your medium-term tax allowances, ISAs being the most common, and each individual has a £20,000 per year allowance. And this can be paid via regular contributions or indeed as lump sum contributions too. Important to bear in mind here is that unlike the previous products that I mentioned, is that these would be paid out of personal income and therefore after tax. So it's certainly worth considering the points that I've discussed. In terms of how we can benefit, we are independent, which means that my job as an independent advisor is to source the best solutions in the marketplace effectively from the whole of market. And that is what we aim to do for clients.